Now we get to turn to the international world, because when we look at the EIA data was, fairly strong across the board. We think it'll get a little bit softer on the product side, where oil will continue to see some, steady drawdowns, nothing too crazy in terms of size, but again, a steady move, and it's just going to be a matter of exports versus imports. So we think we're going to get an increase in imports, but exports are the ones that we've been talking about as being the problem. Russia just came out and announced that, there's a significant amount of Urals sitting there that they are unable to sell. And this is, again, speaking to the softness in in the market in general. And when we look at Libya is now back up to about 1.26 million barrels a day of production, which is going to put more crude on the water. And that's when we look at Libya, what is happening with the Urals, and then what is happening with West Africa, because Nigeria still has over 50% of their, about 50% of their slate to sell, and Angola still has about 10 cargoes for May, and which is about 30%, all of which is much slower than normal. And this is where we continue to see, the narrative kind of breaking down versus what we're seeing in the U.S. market, but versus against what we're seeing in the international market, which is a long way of saying that U.S. crude exports are just going to continue to be under pressure. So let's just take it in different steps. So gasoline had a small decline of exports of 129,000 barrels a day, 92,000 below year over year, but 55,000 barrels above a 5-year. This is going to continue to shift in terms of what the demand looks like in general. So we'll start to see this turn inward a bit more, and exports will start to be below that 5-year average. On a distillate side, it was down 18,000 barrels a day, which is 511,000 below year over year, and 323,000 below the 5-year average. This is what we keep talking about, where that's going to just remain depressed. It's going to stay below that 5-year. It's just going to work between the low end of the cloud and then that average level. And then when we look at propane was up 448,000 barrels a day. Last year we had a big spike, so it was down. It's down 553,000 barrels versus year over year, but 79,000 barrels above the 5-year average. So again, that's something. When we look at Japan, when we look at Asia, the ARB is now back open. So this is going to be supportive of just more LPG heading into the international market. But on the crude side, crude was down 855,000 barrels a day. And again, it's really because we came in at 2.579 million barrels a day, which is what we were getting close to of that 2.6. And we think that we're going to stay between that 2.4, 2.6 million barrels, just based on what we're seeing in the international markets and current spreads, where it's really not conducive to buy from the U.S., especially when we look at where Brent versus Dubai spreads are, where Brent is really kind of priced itself out, and we're going to have to see some of that pressure in terms of spreads to really pull some of that additional crude into the market. So then when we look into what is happening on the level of gasoline exports, when we look over the last 9 years, you can see that we're still above that 9-year average. This is one where we think will just continue to drift closer to the 9-year average in general, which again will be below that 5-year in general as more stays internally, and we come into the middle of the month. We still have a lot of imports to digest, and if we're importing so much, just as Europe continues to build, and Latin America continues to struggle with their own COVID cases, it's going to be difficult to see those exports making sense. Here's when we look at distillate over the last 9 years. Here you can see what we were talking about, where we're just going to not even just go sideways, but start to drift lower, just because we're having Europe that they're taking a bit more from Asia, and they're continuing to try to manage their underlying fuel oil, gas oil storage situation. Then when we look at oil exports, this is where we expect to live. We're above the 5-year average, but below, the highs that have been made over the last couple of years, last two years or so. And we're just going to work kind of within this normal level, as we do have a captive audience due to the kind of crude we're producing. But really, that's a base of about 1.8 million, and then that delta is just going to be what are the spot cargoes, and we're starting to see a little bit of a slowdown in naphtha as Russia's pushing out a bit more naphtha, but we are seeing some of that demand for the NGL side. So then when we look at the propane, here we're back above the 5-year average. Obviously, you see that huge spike. Again, it's always about timing. It's just as we've been saying, we're going to stay really within at least the top of the cloud, or making those new seasonally adjusted highs as demand continues to be strong for not only just our U.S. LPG, but just LPG in general. So then when we look at Europe, so here you can see that on a seasonally adjusted level, Europe oil made a new high, breaking back to the top of the cloud. We expected to see an increase. We didn't expect to see this kind of increase. But just when we look at the demand in Europe, the amount of crude sitting offshore, and just where that competition is, this is just going to remain elevated. We are getting, some refiners are starting to turn back on, and they're in the process of ramping. So this will stabilize. It's not like we're going to surge back up, but again, it's not going to come back down all that much. So we're still seeing some of this onshore storage continue to push highs, and this is really the high that coming back to the high that we saw at from the middle to the end of January. And it's where we continue to see some of this overhang. Then when we look at China imports, so this is what we were talking about before, where imports were up a little bit versus February. As we look into March, it's just some of March imports were deferred. So February deferred into March. So February should have been a little bit higher. Instead, March was a little bit higher. But again, we're just seeing a lot of this coming from offshore onshore. And now that they're coming after the teapots, where they're looking at, why are you running so hard? We've told you to slow down. This is what they do when demand is struggling onshore, and they want to protect the SOEs, or the state-owned enterprises. So they're going to come in and say that you did what you weren't supposed to do, and that's going to push or pull the teapots back down. And again, that's going to hurt some of their crude demand, because as we said in segment 1, the teapots consume about the equivalent to Japan in terms of oil. So again, that's going to eat into some of those demand numbers over the near term. And then when we look at what is happening on frequency levels, so when we look at India, here you can see the surge in cases through April 11th. The total active cases continue to shift higher, but vaccine administered continues to trend up, but the lockdown index is now back to 70. Mumbai has had pretty much has come to an all stop, which again is going to eat into some of that demand, because Mumbai isn't the only one. We're continuing to see some of those issues. And just a quote from a Reuters article: the usually busy streets of the commercial capital of Mumbai look more like a scene from the post-apocalyptic movie. Anybody who's lived in a major city can attest to what that looks like, which is a sign for energy demand in the world's third biggest oil importer. And after dipping by about 2% in March from February, overall consumption of oil products looks set to decline again in this month. So again, this is that overhang that we continue to see in Asia in general. So then when we shift to South Korea is something similar. We continue to see these movements higher in COVID cases, and all this is doing really is just flatlining the reopening. You're just seeing the reopening really come under pressure, and the vaccine doses continue to be slow in large parts of Asia. India's seen a big increase, but China's been slow. South Korea, Japan, in terms of trying to deploy these vaccines, which is eating into public transportation, movie attendance, again, just the general activity within South Korea, which is just a highlight of what are some of the issues and what is that doing for the underlying market. So when we look at Urals for April 26 to 30 loading, they are trading at $2.45 less than dated Brent, which is a bit stronger than the $2.65 they traded on Monday. But as we've been saying, they're trading between $2.75 and $2.35 below dated Brent as they continue to try to compete for market share. And then when we look at Brent in general, so Brent is starting to sell for a slight discount to dated Brent, anywhere from either 5 cents above or 55 cents below, as we're starting to see some of this competition. And then as we get into end of April into May, we're seeing some bids that are a little bit stronger. So it's going to be a matter of kind of where does that shake out? Because if you're having these discounts, that's why we think some of those prices will come under pressure, especially out of Brent. And then just to recap, so Iraq cut crude OSPs for May to Europe by about $3, versus the discount of $2.50. Medium by to $3.94 versus the $3.75. So you're seeing that competition because Iran is pushing more crude into the market, and Iraq is trying to protect market share and trying to compete against that, which again is some of those overhangs that we continue to see. Now, when we look at Fujairah, so Fujairah had a drawdown pretty much across the board. The one that was the biggest was in heavy disti, which is what we were expecting. And we thought that we were going to get some small builds in light and middle distillate. Instead, we had some small draws. But just based on some of the commentary out of the region, we're going to start to see a steady increase. But it's going to be a steady increase. We're not going to get the surge, so we're still going to have fairly stronger numbers in general. So Fujairah had a total of 19.1 million barrels across the three categories, which is a drop of about 1.68 million. Which is down 8.1% week over week. Stocks of light disti dropped 200,000 barrels to about, to that 6 million, 6.01 that you see. But the east of Suez gasoline market remains under pressure as there's those COVID cases that continue to increase in India, but also a fourth wave coming out of Malaysia were impacting that capacity. Excuse me. And then when we look in Malaysia from April 15th to 28th, the 5 states as well as the capital will remain under conditional movement control, while some areas remain under control through the end of April. Middle distillate, again, that India, Asia side continues to be that problem that we're talking about. And then stocks of middle distillate fell 266,000 barrels to 3.08, down about 8%, which is the lowest in a year with them. But the gas oil market was also under pressure as the spot cargoes were being pushed into the market. Despite an uptick in gas oil demand in India for March, those lockdowns they've actually started to cancel deliveries for March or for April, or defer them into May, which again is going to push more into the middle disti storage. But heavy resid fell 1.2 million. Which is down 11%. In the port of Fujairah, activity was a bit muted as the well-supplied market for both HSFO and which is high sulfur fuel oil and very low sulfur fuel oil. Suppliers are optimistic that high sulfur demand would pick up as more scrubbers are installed and they start to get to that fuel. But again, there was a big build in heavy that has now normalized, and now we think that heavy just goes a bit sideways, where we start to get some of those steady increases in light and middle distillate. Now, when we look at the export market, we're seeing again a lot of this already shows those deferrals out of April and into May, which we saw in Nigeria. Norway is getting back to normal after we had some of that downtime for maintenance. The Russia side is the one that continues to be the problem, because we keep seeing deferrals, or at least a really slow selling point, which again is going to be the big issue when we look at how much is Russia able to sell in April, and does that go into May, and what does that do for that schedule? And even though Angola is sitting there with a very low, essentially the lowest in 10-year export level for May, they're still struggling to sell. So when we look at what they had 33 planned export shipments for May, which is, again, one of the lowest in 10 years, and they still can't sell about 30% of them. And we still have Nigeria sitting on about 28 cargoes out of 56. Again, all things much slower. And then the Congo still has the 3 cargoes that we talked about last week, still haven't sold, and they're set to bring on more. And remember, the Congo sells into China, and that's typically their biggest selling point, and we're just not seeing those movements. So, just to give you some backdrop. So when we look at Congo, 43% of the 7 shipments are unchanged for April 17th. And typically, Congo sells into those refiners, and June loading plans are set to come about. Again, speaking to some of the softness in that market. Now, West African crude differentials to North Sea dated Brent have deteriorated since February as European and Asian buyers continue to slow. Bonnie Light fell 25 cents in Feb to 55 cents in March, and now 85 cents below in the first week of April. So again, we're seeing they're trying to find the level where they can just move cargoes, and they're just not able to move it. Angola fell from 62 cents in January to 35 cents in February, and now 13 cents in March. But now we're down again to 55 cents in the first week of April for the heavy sweet Combinda grade. Again, these are the issues that we continue to see. Fewer than 5 out of 43 Ural cargoes from the Baltic ports have yet to find buyers. Traders involved, and unsold cargoes are for late April loading. Ural's program for the first 5 days of May expect to be released. And this is where we continue to see some of this pressure, where some of it has come in for the Urals, but we still continue to see some of the slowdown as some of the cargoes have gone from April into May, and then that's just going to increase what May loadings will look like in general, which is why we're seeing those discounts. Now, when we look at crude oil on the water, we had a nice drop. So instead of seeing an increase, we're seeing a decrease because we're just seeing less in transit. A lot of these cargoes have already showed up. So we actually saw an increase in crude oil and floating storage, but a small decrease in transit, which again is just going to be that timing delay that we keep talking about. So when we look at crude oil in transit, here you can see that that nice drop because we just had things pausing, going into, that slowdown in buying that we keep talking about, which is going to put more crude in storage when we start looking abroad because we're just not seeing that buying power as these different countries try to find that where, at what price can they move cargoes? And we continue to see that slippage in across, key components like West Africa. Now, when we look at floating storage, we're essentially flatlined. This is what we were talking about with some of this flattening, where we weren't going to see a huge increase, but as things go from transit into storage, we're just going to see this continue to drift higher, and the drift higher is going to be driven really across the West Africa, Middle East, and Asia. So when we think about, why is that the case? Well, let's look at Europe first. So here's the backdrop of, we had some small draws across the board, especially in gasoline. And when we look at gas oil in Europe, they're, essentially holding below that 15-year average, which when the people I've talked to in Europe, this is kind of where they want to sit because they feel as though this is an easy place to manage because there's more than enough in the market. So if they need more in the market, they can go get it. But they want to allow room for their refiners to start to ramp up a bit without worrying about competition from the international markets. But then on the gasoline side, we continue to be elevated. I was expecting this to be much closer to this 13-year average. And we're just not getting there because we're just not seeing the activity pick up in Europe the way we'd like, especially on a consumer/gasoline level. Then when we look at Singapore is actually turning higher, which again speaks to the issues that we continue to see in Asia, where the total products, is holding firm at this flattish level, setting, getting close to that seasonally adjusted high. But this is what we've been talking about, where we're going to get a slow trend to the upside. And it's really going to be driven by middle distillate and light distillate as we continue to see pressure in the consumption markets. And this is where middle distillate had a nice little drawdown, which based on what we're seeing in India is going to start to reverse. It's not going to surge back up just because we also have refiners not operating at normal levels. So it's just going to start to turn higher, and it's just going to start to creep up, which again is going to keep total storage elevated as gasoline is already starting, or light distillate is starting to turn up. given the issues that we've talked about in Malaysia, India, and then the slowdowns that we're seeing in China, South Korea, Japan, which is just going to keep this elevated, and it's going to push us closer to the top of that cloud in general. Time spreads across Brent is pretty much flattish. It's up a small amount, about 10 cents in general. It's just, again, as we've been saying, this is going to keep going sideways. We should see a little bit pressure to the upside, given the movements that we've seen in the current pricing today, with crude and Brent up about $3. But as that goes up, that's putting more pressure on Brent, on crack spreads. Singapore continues to work negative, except for hydrocracking. But even on the hydrocracking level, it's still negative once you factor in cost of production and just in terms of storage. So again, this is going to keep some of that demand hindered. And as we talked about on the product side, again, it's going to keep some of that capped in general. And when we look at those hydrocracking numbers, we're still at that seasonally adjusted low, and it's just setting new lows across the bottom of that cloud with little in the way of changing the direction. Urals as well has started to come under a bit of pressure, even though they've maintained some of these really steep discounts, because now those discounts are being challenged by OSPs that were cut by Libya, Iraq that continues to cut, and the U.S. that is trying to take some of this market share. Again, this is going to keep this fairly capped. It'll be positive, but positive will be marginal at best. But it'll keep some of that activity moving, which again will also keep some of that gasoline flowing steadily into the U.S. markets. Then when we look at the Middle East, at the Mediterranean, this has started to roll over, and that speaks to the issues that we continue to see within the Libya and Iraq trying to challenge some of this market, which is why we're going to continue to see some of the margins go flat essentially. But as they go flat, it'll just be a competition of who can compete to essentially get into that cracker. So this should actually stay flattish. The Singapore one is the one that, and Asia in general, is the one where we're the most concerned, where Europe has enough on either side to keep it within a pretty tight range. So supertanker crude imports into China has moved back to I had to adjust it for 2016 to 17, but the numbers don't change all that much. So it comes to that 4-year average. As again, we've seen this delay just because we have China starting to crack down on the teapots in general. And what does that mean? So right now, the independents are running at about 71.2%. And based on what we've been told, or the people we've spoken to, and what is kind of closer to the seasonal norm, they should be closer to 68%. And that's where you're starting to get some of this pressure, where when we look at the state-owned refiners, they continue to drift lower. And again, they want the state-owned guys to have, China needs money, so let's have the state-owned entities instead of the privates, take some of that market share. So this is where you're going to see some of this impact into the numbers. And just to put it into perspective, so looking at this is a mixture of commentary from Bloomberg and Reuters, but China is clamping down on independent oil refiners in an effort to curb overcapacity and stamp out illegal practices. China is trying to curb overcapacity, a move that could potentially affect the growth of China's crude imports, as you get one going from independents into the the SOEs. Private refiners have caused a seismic shift in the global oil market since Beijing gave them permission to import crude in 2015. While state-run PetroChina and China Petroleum and Chemical, better known as Sinopec, still account for the majority of the nation's refining, independent producers processed 3.16 million barrels a day in 2020, rivaling that of Japan or South Korea, depending on what you want to use. So again, there's as they come at these individuals, it's just going to make room for some of the movements, but it's not going to. It's just going to change the direction of imports. But it also speaks to, why are they doing this? The last time they did this is because there was a demand issue internally, and they were trying to protect margin on the SOE side. And again, this is something that I think is very similar, which speaks to a bigger problem when we're looking at Asian demand, specifically China. And then when we look at Asian floating storage, as we were saying, we're going to get the steady creep up. And as we see some of these issues, as the teapots come under pressure and the slowdown, again, this is where we're going to see some of this elevated as China tries to stay steady, but the rest of Asia continues to struggle. Now, North Sea is starting to see these increases again as we see that Asian slowdown, as we see some of the European, Middle Eastern issues. This is going to put more crude on the water as they're trying to move cargoes, which is why we keep seeing this competition on the physical side to move cargoes. West Africa is right at the 5-year average, but based on the issues on unsold cargoes in West Africa, again, this is going to push up as they continue to try to move as discounts increase. Then when we look at the Middle East, this is the one that we were talking about last week where we're starting to see this shift up where Iraq is putting more on the water, UAE, Saudi Arabia, and we're seeing a pressure on moving some of these cargoes. India is already annoyed. They're trying to increase West African cargo runs. And even though they're trying to increase it, we're still not seeing those movements, which means that Saudi isn't selling to India at the same level. They're trying to maintain flows into Europe. So again, this is where we're continuing to see the steady increase on floating storage in the Middle East, which again we think is going to take out that 2021 high. Obviously, not getting to where we were in 2016, but we're going to start to see some of these increases on a steady level. Where Europe is right along those 5-year average, which is why when I look at onshore, there's enough to keep onshore well supplied while we typically see some of these increases. And as we're not seeing European crude move into the international market, it's going to leave more on the water and put more into their storage. And then when we look at Shandong, they continue to be at seasonally adjusted all-time highs in terms of what is in storage, which again is putting pressure on them. And then more importantly, when we look at fuel oil. So fuel oil is pushing back up to the highs, and even though seasonally we normally see these increases, but the fact that they're pushing back up on fuel oil, and now you're getting a crackdown from the Chinese government, it really is indicative of a bigger problem, and it's hard to tell because it's China and we're never playing with a full deck, just given the opaque nature of their data. But we try to get inference in terms of what are the ships doing, imports, exports, what is the Chinese government doing, and then what are storage levels that we know about. And this is where we start to we remain concerned on what is Asian demand look like. And that's why we think that there's going to be more than enough product abroad to come on shore. And again, these are going to be those friction points that we're talking about as obviously crude continues to run up $3.13 with WTI sitting at 63.31, just because there's again this capping component that the market doesn't or at least isn't understanding, or at least doesn't care about at the moment. But these are things, again, there was the positiveness on the EIA side, from last week. Things will get a little bit softer on the product side, but I don't see too much change on the oil side, which the market could be saying is a net positive, even though some of the global level or the international level continues to weaken, especially in Asia. So if you have any questions, love to hear the back and forth. We're always looking to learn what other people are thinking, because obviously there's two sides to every story and to every to the market, which is what makes a market. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.